All right, a while ago, I had posted a portfolio that was based on the risk parity concept. And it was basically only 4 assets. And I got a lot of questions on it. And you may remember what it looked like. I made a slight modification since then that doesn't change the results so much, but I'll post a new allocation here. The original allocation is fine as well, and I think that some of my friends are using it, so it should work. But I just made a small tweak. But there was some interesting question that was raised. One of them was, why didn't I include any international stocks or mid-cap stocks? And it was really only growth stocks, small cap value, long-term treasuries, and then gold. And today I'd like to talk a little bit more about my reasoning for that. So let's get to the computer and take a look. One of the first things we want to look at is something called asset correlation. So what I have here are 3 portfolios, and they're really not even portfolio, but they're just basically 3 stocks that represents different baskets of equities. So the first one is just all world stocks minus the US. That's this one, VXUS. The second one is the US stock market represented by VTI. And then this one is the Vanguard Mid-Cap 400 ETF. Okay? So basically you have world stocks here minus the US stocks here, and then mid-cap stocks. And then I ran this analysis that goes back to 2012. So granted, it's not a very long look back, but it's good enough to illustrate the point. So we have portfolio 1, 2, and 3. And then here you have the returns over the last 9, almost 10 years. And as expected, world stocks are not doing that great. So non-US stocks, they're lagging behind US stocks, and they have been for quite some time. When you look at total US stocks versus mid-caps, they're fairly close. And then when you go over to this last column and you look at market correlation, this kind of gives the reason why I didn't include world stocks or mid-cap stocks in my portfolio. In the past, it used to be that international stocks gave you a lot of diversification. But in the last 10, 15 years, if you look at the correlation with the US market, world stocks, international stocks is 85% correlated. That's very highly correlated with the US market. Mid-cap, even more so, 94%. Okay? And of course, VTI, being the US market, has a perfect correlation of 1. But because of this reason, I didn't include world stocks or mid-cap in my allocation just because it's very correlated with the US market. So there's no point in including it, is my basic reason. So how did I come up with this allocation? Well, I've been reading up on and kind of studying this concept, which basically says that, instead of allocating your portfolio based on the, some weighting of different asset classes like bonds, commodities, precious metals, stocks, whatever, right? Based on some arbitrary rule, maybe it's market cap or some other things like that, that you should view it as different risk contributions to a portfolio, and you should build a weighting based on how much they contribute to the overall portfolio's risk on the underlying correlation between the different assets. So what I did was I had worked on a model within Excel that basically solves for the optimal allocation based on risk contribution to the portfolio. And if anyone's interested in running this on their own, I'll share this workbook. But when I set it up back in March, I kind of gave some directions on what you have to do. But basically, what you need to do is to gather all the assets that you're interested in. And at the time that I did this modeling, I'd chosen pretty much the same kind of asset class. I might have included something extra. And some of the specific ETFs or funds that I'm using now are slightly different from when I ran it in March, but the concept is exactly the same. What you do is you find out the returns for those assets and their volatility, and then you work out what's called the correlation matrix. I'll zoom in a little bit here so everyone can see it. But you put in the correlation matrix for all of your assets. So this matrix basically tells you how they're correlated with each other. Okay. So the Vanguard Growth ETF is 100% correlated with itself, right? So on and so forth. But only 76% correlated with small caps. And you can go all the way across and read it for the rest of it. And then using Excel Solver, we come up with how you should build your portfolio. So in a regular portfolio, you may be weighting your assets based on just an equal weight or something else. So maybe you're starting with like a 60-40 mix, right? So this is the concept here. So the first three assets are stocks, and then you have bonds, gold, and then real estate. So these are alternative assets. So this is really a 60-40 mix, and the stocks are split evenly into three, and then you have bonds at half of the other 40%, and then your alternative assets making up the balance, right? When you look at the volatility for those assets, the return based on the asset weighting is about 10.62, and the volatility is going to be something like 12-15%. I didn't work it out for this model, but that's what it works out to be if you use like the asset weights. Okay, and then using Solver and the correlation matrix between these assets, I worked out what's the proper weighting if you were using risk weights. So the risk weights are a little bit different, and you can see how it all changes, but they total up to 100. And when you take this risk-weighted portfolio and you calculate the weighted returns based on the risk weighting, it's actually a little bit higher with less volatility. Okay? So a way to visualize that is to kind of look at it on a chart. And this chart here shows what the risk parity allocation would be for these assets based on their risk weights in the light green, whereas the kind of teal is based on like a 60-40 mix. Okay? And you can see how the weightings are different, but you get a better result is the bottom line. So we go to Portfolio Visualizer and look at what I had came up with originally. This was my original mix. It's basically a 60-40 stock split. I heavily weighted my stock portions into growth stocks with some small cap value. And then the balance is mostly in long-term treasury with a little bit of gold. The only modification that I did recently was that I took that small cap value basket and I split it into two and made the other half real estate. And for real estate, you can use a fund, a REIT like VNQ or REET. I just happen to use O, which is a single company, but it's a REIT, it's a Realty Income Corporation. You can do whatever. When I ran this, the returns are very similar. The main benefit of splitting it out this way is that the drawdowns are improved slightly. But like I said, you don't have to use this, kind of revise allocation. The original one's going to work just fine. So what I'm going to do over time is to slowly move into this allocation from where I am now as I get closer to pulling, the trigger on financial independence. Right now I'm heavily into equities. I have some cash holdings for dry powder, but eventually I want to get here. And to test this out with real money, what I did was I built an M1 Finance portfolio. Go ahead and log back in here. And I've been running this portfolio in earnest probably since March. So when you look at the value over time, I'd signed up for M1 Finance, back in September of last year, just to kind of test out the concept. And I'll talk a little bit about M1 Finance in a different video, but basically, I didn't have a whole lot of money in M1 Finance until about March. And you can see it just shoot up. And the reason was that I started adding a lot of money to this primarily to test this risk parity concept. So when you look at the slices within this risk parity portfolio, it's the same slices that I had in the spreadsheet. Okay, so it's the same as this. The one change that you see here is that I had started with a 20% allocation to small cap value, but then decided to split that in half to a REIT. And that's why this is slowly shifting, but that's the intent, right? So I've been doing this since about March, and we're at the beginning of July, end of June. So if we were to look at 1 quarter of this, the return over 1 quarter has been about 8.58%. As an alternative, I also built a pie. I'm not going to get into the terminology for M1 Finance, but I built a pie with just the S&P 500 as represented by VOO. Okay, so VOO, and it's 100% there. And over the same time period, 1 quarter, the S&P was doing great as well, up 7.5%, right? It's been making record highs pretty much every day for the last couple of weeks, right? But still, the point here is that over the same time period, I'm getting a slightly higher return, so about 1% higher, and the volatility is actually a lot less than if you were invested in just the S&P 500. Now, I use S&P 500 because it's pretty much the US stock market. It's like 99.9% correlated. So whether you use VTI or VOO or SPY, it's going to be roughly the same. So I'm getting better return with a lot less volatility using this risk parity portfolio. Now, will it always do this? Not necessarily. The point of risk parity is that you give up a little bit of return for less volatility and lower drawdowns. That's the main point of risk parity. So when you compare, standard deviation and drawdown, so let me go ahead and just add in, either VTI or I'll do VTI. It's good enough. Okay. So total stock market. So the whole point here is to lower the standard deviation. So if you were 100% in US stocks, you have a standard deviation of 15%, right? You're cutting that by 1/3 by using this risk parity portfolio. But even more importantly is this concept of the maximum drawdown. It's less than half, right? Which is super important if you're going to start to pull funds from it to pay for expenses. And that's the primary reason that I wanted to move to this portfolio over time. Will it always have a better rate of return? I don't think so, just because of the concept, but over the last quarter, it has done that. So I'm going to try to give an update every month on how this risk parity portfolio is doing. So over the month, it's returned 3.04%, whereas if we looked at the S&P 500 over the same time period, it's 2.5%. So it's actually doing pretty well. We'll let that run, and I'm going to contribute, very small amounts of money. This is not where most of my funds are, but this is really a test. I will say that I am shifting like a shitload of cash to this portfolio because they are paying like a ridiculous 1% API on cash balances. So I'll keep cash there and get that 1%. I don't know how they're doing it, but it's pretty amazing, and it's FDIC insured as well. Anyways, we will leave it at that for this video, and I'll try to do an update every month just to see how it's doing. I don't expect that we're going to see this return, all the time. But so far, it seems to be doing what it's supposed to. So check back next month, and I'll have another one for this specific portfolio. All right, thanks.